Stop loss. Use it or lose it. Trading without a stop loss is like driving a car high speed down a curving street with no brakes. You may be able to go through a few curves unscathed, but sooner or later you're going to crash. It's the exact same concept when you trade without putting a stop loss in place. Hi, this is Lode with Black Bear Dog Trading, and today I want to talk about stop loss. You already understand now why it's important, but the problem that a lot of traders have is where exactly do you place stop loss? And when you place it too close, what they call a tight stop loss, you get stumped out. When you place it too far away, you put too much money at risk. So what's the golden spot here? What do you do? Well, it all depends on, first of all, we're dealing with Forex here. It all depends on the currency pair you're trading, number one. Number two, it also depends on the time frame you're trading. And number three, it depends on whether or not there is a current news that is affecting Forex trading, or the Forex market, I should say. It's known as volatility. The higher the volatility, the wider your stop loss should be because of the rapid and wild swings that can take place. And the lower the volatility, the shorter your stop loss should be, because these currency pairs don't swing erratically, they are more steadily, they are more evenly, and so you can afford to have a tighter stop loss, thereby risking less money. The problem is when you go too tight, you get stumped out, and when you go too far, you lose far too much money. As a golden rule, and I've written it down right here on this site, if you trade a low volatility pair, for example, the Euro US dollar, which is pretty steady, has few to no drastic swings, and works particularly well with the 1 hour and the 4 hour time frame, you can get away with 20 to 30 pips in for your stop loss setting. It's 20 or 30 pips either below the entry point when you go into a buy position, or above the entry point when you go into a sell position. You can then further adjust your stop loss with increments of 10 to 20 pips every time you make a certain amount of profit, known as trail steps or trailing steps. Now, if you prefer to trade something with a little bit more volatility, because the potential for more trade opportunity is there, and also the potential to make a bit more money with still not crazy amount of risk, then you could trade the British pound US dollar. And again, the 1 hour and the 4 hour chart are considered ideal for trading the British pound US dollar. Just remember, while they're not extreme in fluctuation, price tends to be a bit more erratic than the Euro US dollar, and therefore your stop loss should be set a little higher or a little wider, and it is recommended 30 to 50 pips from entry point, with a trail step that is also a little wider, 15 to 25 pips. Then, if you're interested in trading a high volatility pair, which is a currency pair that has big swings, that trades very erratic, that 1 minute you can be, I just say, example, minus $100, and 2 seconds later you're up $200, very erratic, then it's recommended you use the 4 hour or the daily chart to minimize having a ton of full signals, because the 4 hour and the daily chart automatically are slower and take a little bit more time for the candlestick to form, being one full day if you're on the daily chart. The advantage of that is, because of the large swings, you can have a tremendous profit but you can also have tremendous losses. And as you can tell, it is recommended with high volatility that you set your stop loss anywhere from 50 to 100 pips from entry point, with trailing steps anywhere from 20 to 50 pips. So you're definitely taking more risk there. So it's a matter of you figuring out for yourself whether you want something that is stable, more even flowing, a bit predictable, which is low volatility. Then you would trade the Euro USD. You prefer a little bit more excitement in your life, go with the British Pound USD. And if you're really a risk taker, borderline gambler, then absolutely go with the British Pound Japanese Yen. It is a personal preference. The point I want to make here is that you have to have a trailing stop in place regardless of the currency pair you use. Now, calculating pips is not exactly everybody's forte. Not everybody, even though it's simple math, not everybody likes to do it. It has nothing to do with whether you're good or bad at math. It's simply, well, I'm sitting right now at this particular level here. I gotta add 30 pips to this. Okay, where would that bring me? Around here. So I gotta put my stop loss. It works, obviously it does, but it's too complicated. So I'm going to give you a solution that's a heck of a lot easier to do and also much easier to implement. And it's what I call the, oh, now I'm messing up all my windows here. It is what I call the high and low stop loss. And it's very simple. When you enter a position like I did right here, I just did at the start of this video, you then go and set your stop loss at I entered here. You set your stop loss, in this case it's a buy position, at the most recent low of price. If I would have done the reverse and entered a sell position, I would set my stop loss at the most recent high of price, which in this case would have been right here. That is very simple, very easy. Granted, you're not dealing with pips, and maybe you, by putting the most recent high and the most recent low, you may feel like, well, that's a little bit more money I want to risk. There is no problem with that, because once you set the stop loss, you can easily adjust it afterwards to what you would like it to be. In my case, I have it now set at the most recent low, risking $960. Let's say that's far too much, so I can easily move it up, drag, and now I put it here, and now my risk is $448. It really is that simple to manage. Most crucial, most critical is that you have a stop loss. And it is literally through trial and error, through experience, that you'll learn what works best for you based on the time frame you trade, based on the currency pair you trade, and based on what is happening in the real world. Is there a sudden news report that is throwing currencies up in the air, or is world economy pretty much easy peasy? So those are a couple of decisions to make, but they're not difficult. I mean, as you can tell, just talking to you here, I made those decisions in less than a minute. So it's just a matter of applying, and regardless of how you trade, and regardless if you're a high risk trader, a medium risk trader, or a low risk trader, always, and I absolutely can't stress that enough, always use a stop loss. That's it for today. I will see you in the next video, where I will explain in more detail exactly what volatility is, where it comes from, and how it affects the asset that you trade. Until then, take care and God bless.